Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, May 6th, also known as Oaks Day.
Exactly.
3-year-old fillies run today out at Churchill Downs, day ahead of the Derby. Derby's tomorrow. I have my Derby tie on, and Moose and I are horse racing fans. I really look forward to this weekend after the last few weeks of the markets.
Oh, absolutely. It's a very nice diversion, I might say.
Yeah. It'd take your mind off the markets for about, an hour or so. Although there's some other great races tomorrow,
absolutely.
too. Yep. Yeah. We'll get to our picks at the end. In terms of markets, everyone is looking at indices, averages, a lot of pressure, a lot of volatility. Important, again, and we've mentioned this before, to differentiate between risk and volatility.
Correct.
Two different terms that sometimes get used interchangeably. We're seeing an awful lot of volatility in some areas and risk in others. Risk are some of the equities that need to raise capital to fund growth, need to raise capital to fund operations, where volatility affects everything. You don't have the same degree of risk and volatility in a name, for example, like Microsoft, as you do in a biotech or an unprofitable tech company.
Right.
So it's important to differentiate between those two things. And sometimes it's difficult for clients, and I started to see last week and this week maybe some decisions made by clients that aren't in their best respect in terms of their portfolios, changing allocations, right. Making panic decisions when you've put together a 3, 5, 10-year plan, making panic decisions based on 30, 60, 90 days of trading.
Often a sign that you might be coming towards a bottom in the market when those kind of things happen.
Maybe, and that's always tough to tell.
Right.
I'll put a chart up here now, John. This is just a weekly momentum chart that we're looking at. You can see that we're getting there. And when I say getting there, we're getting to the point where most sectors have moved down into what I call the green area, the area where you may want to start to look to pick. You may, if you have some cash, you need to not just worry about risk all the time in a bad market, but weigh opportunity as well.
Right.
So as you see a compression to the left of this chart, when we get down to where single digits of sectors are trading with positive momentum, that's when we look for a small reversal to the upside in the momentum number. So we don't have to guess here and just buy blindly, but we're certainly going through names and sectors on a daily basis. I mentioned on the call the other day, two that have kind of popped out to me in terms of how their internal companies within the baskets are trading. Believe it or not, as hated as tech is, semiconductors are trading pretty well. Now, I say that relatively. They're trading pretty well. You know what else is trading pretty well, John? Transports. Interesting, right? We're worried about inflation and possible recession, yet transports are starting to hang in there. So those are two areas I'm digging through for possible additions. Energy continues to trade well. I don't have enough of it. Have it in some different ETFs, and obviously Berkshire in tactical trend being a big holder of Occidental Petroleum, synthetically gets us long there. But energy is the only stalwart outside the US dollar. So we're getting there. Try to control your emotions. Try to differentiate between risk and volatility, and try to understand not turning the light switch on or off, all in, all out, and continuing to jump. Please don't think that's a way to manage money. Whether you're doing it with an advisor, whether you're doing it on your own, we want to be flexible and dampen portfolios. We have time to do this. Markets open next week, week after, month after. Yeah. What do you have in bonds, Moose?
Crazy week in bonds. Not tremendous movement, but pretty good movement. You look at the 10-year bond, 294 to a 312, 18 basis points, pretty high. 30-year bond went from a 3 to a 322, that's 22 basis points. It's how it got there, because wrapped around that was probably another 5 to 8 basis points on either side of that. And what happened? We saw at the Fed meeting on Wednesday, Jay Powell, the chairman, announced you're going to do 50 basis point hike. The market was expecting a 50 basis point hike. What he did is he said, we're not thinking in terms of a 75 basis point hike. The market liked that, bond market liked that on Wednesday. Yields came down, bonds rallied, stocks rallied after the announcement. Gave it all back yesterday and more so today. So all over the lot. But what you look at when you take that step back and try to remove yourself from some of the mayhem that's out there, you realize that bonds are basically back to where they were in 2018, kind of the middle of 2018, almost at the peak of 2018. So it's not like you're out in the lunatic fringe yield-wise. Again, we always say it's the ascent, the swiftness of the ascent in rates that spooked everybody.
That's it.
And in Munis, actually, this week, pretty well behaved. They were up about 12 ticks in yield. Very good demand for paper. Again, we say we're out there trying to buy 4% tax-free yields. We think that's, and quite frankly, this week is more like 4.25 compared to 3.25 on a 30-year bond. Very good value in our view. I think what you really want to accent, though, is taking appropriate action when you have it. And in this case, this is using a time to do tax loss swaps in bonds.
Sure.
While you have the opportunity. Not changing the structure of what you own, but accumulating that tax loss that can be used down the road. So we're doing that as well.
Two quick things, John. First off, for years, the main pushback, or I don't want to say complaint, we've had from fixed income clients was lack of yield.
Right.
Now you're starting to get that yield, but with that comes some pain.
Right.
You can't have strong bond prices and big coupons, big yield. So to get to the point where yield makes sense, where if we went back a year ago, John, and you said we could be buying 4s and 4.25s, people would be jumping up and down. But to get there takes a little punishment.
Right.
You got to tough it up a little bit. Am I right?
Right. And as you said, there's no lack of yield, and boy, there's no lack of fear either.
Yeah. And you mentioned fear, and that's one thing I have had my eye on. If there's one thing that bothers me in the equity market, besides prices and weaknesses, is that put-call ratio, to go back to it from last week, that is available, by the way, on the CBOE.com. We had a viewer ask last week. It really isn't edging higher. Now, the pricing and some of the velocity of the down moves tells me there is some fear, but I'm surprised that hasn't jumped higher. So I'm thinking that what we're seeing is more a lack of liquidity than fear. That's a concern to me.
And there's lack of liquidity in the bond area too. You get away from treasuries, and the bids on corporates or taxable munis or regular munis is a little sloppy. Although, like I said, new issues where people can know where a clearing price is, and when they're coming at 4.25 or around that area, are getting good demand. And we want to add one thing on the credit side. I visited some of our clients in New York and New Jersey this week. I got back today. All the talk last year about New York never coming back, and like, you can throw that away. Hotels, absolutely packed. Subways, very packed. Not maybe as pre-COVID, but pretty packed. Commuter trains, packed. So people are back in the city, and it's really
you were consistent with that view.
Yeah,
you fought against that from day one.
Right.
So it's good to see. And in terms of travel, we are seeing that pick up and leisure pick up, but there's that battle against the fear of recession caused by higher rates. Does that pinch everything leisure-wise? We'll see. Yeah. Now, Moose, Kentucky Derby. Who do you like? How about this? How about a winner and a long shot? A shorter price and a long shot.
Well, I like Taiba.
Yeah, and that's a mid-price, yeah.
Mike Smith, like jockey, would be the oldest jockey ever to win the Derby. He won the Santa Anita. You know, I don't know whether you would consider him he's not really a long shot. He's not really a favorite either, but he's low. I really don't have a long shot.
Okay, yeah, Tybee morning line's 12-1, so you go to the window with that.
Yeah, it's pretty good. Messier's one, you know, it's probably a
yeah. Messier and Tybee were 1-2 in the Santa Anita. I like Messier an awful lot, so I'll go with Messier. You know, I like Zandon an awful lot. He won the Bluegrass. He's going to be a shorter price, so you can mix the two up, maybe play an exact and have some fun.
That should be good.
Okay. Don't forget to like, comment, subscribe, turn on your notifications, and we will see you next week. Enjoy the weekend.